Buy and hold. Buy and hold is a strategy where an investor purchases stocks or other assets and holds onto them for an extended period of time, regardless of short-term market fluctuations. The idea is to benefit from the long-term growth of the investments rather than trying to time the market by buying and selling frequently. It's like planting a tree and letting it grow over time without constantly digging it up to check its progress. Cryptocurrency. Cryptocurrency investing involves buying, holding, or trading digital currencies like Bitcoin, Ethereum, or other altcoins. Investors may purchase cryptocurrencies as a speculative investment, believing that their value will increase over time. They may also use cryptocurrencies for transactions or as a safeguard against traditional financial systems. Venture capital. Venture capital is a type of financing provided by investors to startup companies and small businesses that are believed to have high growth potential. In exchange for their investment, venture capitalists receive equity in the company, meaning they become partial owners. Unlike traditional bank loans, venture capital funding is typically provided to early-stage companies that may not have established revenue or profitability. Precious metals. Precious metals investing is a strategy where individuals or institutions purchase physical metals such as gold, silver, platinum, or palladium as a means of diversifying investment portfolios or protection against economic uncertainty. Arbitrage. Arbitrage is the process of buying and selling assets simultaneously in different markets to take advantage of price differences and make a profit. Let's say the price of a stock is $10 on one exchange and $11 on another exchange. An arbitrageur would buy the stock at $10 on the first exchange and simultaneously sell it for $11 on the second exchange, making a profit of $1 per share. Contrarian. Contrarian investing is where investors go against the mainstream market sentiment. Instead of just following the crowd, contrarian investors seek opportunities in assets or markets that are currently undervalued or out of favor. They believe that markets often overreact to news or events, causing assets to be mispriced. Contrarians aim to buy assets when they are undervalued and sell them when they become overvalued as the market sentiment shifts. Momentum. Momentum investors focus on buying stocks that have recently shown strong performance, expecting that the upward trend will continue in the short term. They typically buy high and sell even higher. It's like joining a race where you pick the fastest runners, expecting them to maintain their speed and win the race. Sector rotation. Sector rotation is when investors adjust their investment allocations among different sectors of the economy depending on economic trends or other factors. For example, in times of economic growth, they might invest more in sectors like technology or consumer goods, but in times of decline, they may switch to safer sectors like healthcare or utilities. Real estate. This strategy involves purchasing properties with the intention of generating income or achieving capital appreciation. Investors can earn rental income from residential or commercial properties and may also benefit from property value appreciation over time. Dollar cost averaging. This is a technique where you invest a fixed amount of money at regular intervals, such as monthly or quarterly, regardless of the investment's price. This steady approach helps you avoid the stress of trying to time the market and can result in buying more shares when prices are low and fewer when they're high. Dividend investing. A dividend is a payment made by a corporation to its shareholders, usually in the form of cash or additional shares of stock based on the company's profits. Dividend investing involves buying stocks and companies that pay dividends regularly, with the goal of generating income from these dividend payments rather than relying solely on capital appreciation. Tactical asset allocation. Tactical asset allocation involves actively adjusting your investment portfolio based on short-term forecasts or market conditions. This strategy aims to capitalize on temporary flaws or patterns in the market's behavior to either increase profits or reduce potential losses in the short term. Large cap. Large cap investing focuses on investing in companies with large market capitalizations, typically those with a market value of $10 billion or more. Large cap companies are often well-established, mature companies with a stable track record. Investors may choose large cap stocks for their stability and relatively lower volatility compared to smaller companies. Peer-to-peer lending. Peer-to-peer lending is a form of investing where individuals lend money directly to other individuals or businesses through online platforms without the involvement of traditional financial institutions like banks. Investors earn returns through interest payments made by borrowers over the term of the loan. Value investing. This strategy involves identifying undervalued stocks or assets that are trading at a price lower than their intrinsic value. Value investors believe that these undervalued assets will eventually increase in price to reflect their true worth, providing an opportunity for capital appreciation. Forex trading. Forex trading, short for foreign exchange trading, involves buying and selling currencies in the foreign exchange market to profit from changes in exchange rates. Traders aim to buy a currency pair at a low price and sell it at a higher price, or vice versa. It's a speculative market influenced by economic factors, geopolitical events, and investor sentiment. Scalping. Scalping is a trading strategy used by traders to capitalize on small price movements in financial markets. Traders who employ this strategy, known as scalpers, aim to make numerous trades throughout the day, holding positions for very short periods, often just seconds or minutes. Global macro. Global macro investing is a strategy where investors analyze and make bets on broad economic trends and events happening around the world. Instead of focusing on individual companies or sectors, they look at the big picture, like changes in interest rates, inflation, currency fluctuations, and geopolitical developments. Satellite investing. Think of your investment portfolio as a solar system. Your core holdings, like blue chip stocks or bonds, are like the sun. They're the big, stable center around which everything revolves. Satellite investing is like adding smaller planets or moons orbiting around your main holdings. These satellites can be more specialized or focused investments, like tech startups, emerging market stocks, or real estate funds. By adding these satellites, you're diversifying your portfolio and potentially capturing extra growth opportunities beyond what your core investments offer. Buy the dip. Buy the dip is a common investing strategy where investors purchase stocks or assets when their prices have experienced a temporary decline or dip in value. The idea is to take advantage of lower prices with the expectation that the asset's value will eventually rebound, allowing the investor to profit from the eventual recovery. Distressed debt. Distressed debt investing involves purchasing the debt of companies or entities that are experiencing financial distress or facing bankruptcy. Imagine there's a once popular store in town that's struggling to stay open because it has a lot of debt and its sales are declining. A distressed debt investor might step in and buy a significant portion of the store's debt from its creditors at a discounted price. With this leverage, the investor could then work with the store's management to implement changes to improve its operations, such as cutting costs, renegotiating leases, or revamping its marketing strategy. The goal is to either turn around the distressed company, negotiate a favorable repayment plan for the debt, or liquidate the assets to recover as much of the investment as possible. Defensive investing. Defensive investing is a strategy aimed at minimizing risk during periods of economic uncertainty or market downturns. It typically involves investing in assets that are less volatile or less affected by economic cycles, such as healthcare stocks, utility stocks, precious metals, dividend-paying stocks, and stable companies with consistent earnings. Defensive investors prioritize capital preservation over aggressive growth, focusing on steady returns and reducing the impact of market fluctuations on their portfolio. Growth stocks. Growth stocks investing focuses on investing in companies that are expected to grow at an above-average rate compared to the overall market. These companies typically reinvest their earnings into expanding their business operations rather than paying dividends. Investors are attracted to growth stocks for their potential to deliver substantial capital appreciation over time. It's like investing in young, fast-growing companies that have the potential to become industry leaders. Impact. Impact investing aims to generate positive social or environmental impact alongside financial returns. Unlike traditional investing, where the primary goal is maximizing financial returns, impact investing considers both the financial and environmental outcomes of an investment. An example of impact investing is investing in a renewable energy company that develops solar panels and other clean energy technologies. Wine investing. Wine investing centers on purchasing wine with the expectation that its value will increase over time, allowing the investor to sell it at a profit. Factors influencing wine investment include rarity, quality, producer reputation, vintage, and market demand.